All right. Today is Monday, August 30th. We're almost done with the month, folks. Anyhow, this is a recap for the stock market activities today. We go back to the guideline I gave you last week. In the morning, yields were down for the 10-year, that is, and the dollar was trading slightly higher. That paves the way for scenario number 2, in which the Nasdaq and technology stocks managed to outperform. And this is exactly what was happening in the morning. The Nasdaq was outperforming the Dow Jones, the S&P 500, and the Russell 2000. As the day progressed, we saw the US dollar also trading down slightly. And that opened the path for scenario number 4, in which pretty much everything outperforms. It's a good day for everything when the dollar and yields go down together. This is, of course, the guideline for now. Things will change in the weeks ahead. But for now, so long as the algos are in control, this is how the algos will behave. This is the guideline that algos follow. In the meantime, we're talking about algos and robots controlling the market right now. Where are the institutionals? The institutionals are not buying anything. The institutionals are waiting and waiting and waiting for the seasonality in September to play out, which is the weakest month for the stock market, historically speaking. Therefore, if anything, the institutionals are hedging. Meanwhile, the retail crowd, once again, they're busy with meme stocks. Today was also a meme stocks kind of day, and we will talk about all of these tickers in the options market coverage. The retail crowd is busy chasing the hot trade, making a quick buck in out. Of course, these are the smarty pants. The dummies, the Robinhoodians and the likes, they fall in love with the stock. This is going to be the future, bro. The epic short squeeze, etc., etc. But needless to say, this was, all in all, a good day for meme stocks across the board. And we have new tickers, by the way. They pop all over the place in these chat rooms. Traders follow through, and you see massive pops in tickers you've never heard of before. But in focus tonight, I want to talk about the SEC because we have Gary Gensler making some comments about pay for order flow and the future of Robinhood in particular. Likewise, we're going to talk about Alibaba by popular demand, by the way. You guys asked, I'm going to answer. And lastly, let's talk about stagflation for a little while and the stagflationary forces by Dr. Doom and Gloom, Professor Rubini. Of course, earlier in the day, we got news from PayPal. PayPal is now thinking about a new service, a new trading platform within the PayPal ecosystem. PayPal has millions and millions of customers already signed in, whether it is for the PayPal services or Venmo. In any case, this was whammy number 1 against Robinhood. And the moment we got the news, Robinhood went down. And here comes the double whammy out of the SEC. In an exclusive interview with Barron's, Chairman Gary Gensler indicated that banning paying for order flow is quote-unquote, on the table. Now, this will be extremely horrific for Robinhood because it kills their entire business model. The accusation is that pay for order flow is illegal to begin with because it gives the institutional side the advantage, and it puts retail investors and traders at disadvantage. On the other hand, removing all of these excessive fees that other trading platforms used to charge was also good for retail traders and investors. Unfortunately, it also opened the door for gambling and speculative activities, excessive speculative activities, specifically when it comes to options trading. Believe it or not, and it's really silly, but this is reality and how psychology works. When you have no fees in an options trade, you're conditioned to take more risk. But somehow that $5 fee per trade lessens your appetite for risk. You have no problem risking thousands and thousands of dollars on a call option with the expiration date of this upcoming Friday, weekly expiration. You're risking thousands and thousands of dollars. But somehow that $5 in fees per trade, that's too much, bro. $5, that's a lot of money. The psychology alone prevented the speculative activities, but it was not a strong buffer. We saw that back in the 1990s. I don't know what the argument is that Gensler is leading with, but from what we know, the SEC has been in a coma. It's a dormant organization. Take whatever they say with a grain of salt. The market is an unregulated jungle. Just take a look at what happened today in Apple stock, for example. They're buying millions and millions of call options all of a sudden. We have over 100 million shares in notional volume traded today via options in Apple stock. We're talking today alone. Do you know how much 100 million shares of Apple are worth? Today alone, the stock created about $100 billion in value out of thin air. For what? New colors optimism? How about satellite optimism? You know, there's an analyst who leaked some information about Apple iPhone 13, whatever the new one is, using satellite technology. Who knows what the analyst's conflict of interest is? Who knows what their end by publishing this information is? Who knows? The market is an unregulated jungle. So take whatever the SEC says with a grain of salt. Once in a while, they wake up out of the coma, pretend that they're tough, and then they go back to sleep once again. Next, we have the story of Alibaba. Lots of retail investors and traders are asking about Alibaba. Should I buy? Should I sell? Is it oversold? The answer is yes. It's an oversold stock and perhaps the most undervalued stock in the world right now. The question is, should you buy it or are you going to continue to catch a falling knife? We know that institutional investors are exiting Alibaba. They're dumping Alibaba. They're done with Chinese stocks. And of course, when institutionals dump, we have retail to pick up the dumps and pretend that they're smarter than the institutional side. There is a rule in the stock market that says follow the money, but try to convince retail investors, specifically the SPAC generation that invaded the market last year, good luck convincing them that perhaps this is not a wise choice to buy the dip in Chinese stocks. Do you have any guarantees that Chairman Xi will not come out tomorrow and order all of these Chinese stocks to be delisted from American markets? You don't know that, but here was a tweet that I issued back in December warning investors and traders not to buy the dip in Alibaba. And this is what I said about the stock in the past. Moving on to Alibaba, the whole fiasco that happened last Friday in the Hong Kong market, and we saw a subsequent decline of over 16% in US trading for Alibaba. Well, now Alibaba is trying to soothe some of the concerns by saying that they will raise the stock repurchasing program from 6 billion to 10 billion. So please do not sell your Alibaba shares. This is, of course, what Alibaba executives want you to think. The reality is that China as a system is rethinking the whole billionaires thing, allowing entrepreneurs to become very powerful and have an enormous amount of wealth comes with making these people very, very powerful. Powerful enough to challenge the system, aka the Chinese Communist Party rule. And all what Jack Ma did is just a slight criticism to the regulatory system in China, and he is getting punished severely. And I think that China is going to rethink its strategy of allowing these individual entrepreneurs to become extremely wealthy. They will either need to have some sort of loyalty test that these entrepreneurs will remain loyal to the CCP, or they're going to have to forego the system altogether and limit how powerful and how wealthy these individual entrepreneurs are going to get. This is a recipe for disaster in investing in Chinese stocks. We're talking about NEO, we're talking about Xpeng, we're talking about JD, etc., etc. Because what guarantees do you have that the Chinese company you're investing in is not going to be the next target of Chinese regulatory authorities? You don't know that, and this is why I keep avoiding investing in Chinese stocks. And here is a bonus chart for today's episode for Alibaba. Here is a weekly chart, and we saw the massive drop after the news regarding the disappearance of Jack Ma. And the dip was bought right away, pushing the stock all the way to the resistance of the Fibonacci retracement level of about 275 before reversing lower, going all the way back. We do have confirmations from both the Fibonacci and the MACD indicator that there are lower prices to come for Alibaba. And my number here is 180. 180 will be an extreme correction, and you should see Alibaba bouncing higher and holding support. But for now, we have a confirmation from both the Fibonacci and the MACD that we have a lower leg to visit. And here is the update, by the way. We talked about the head and shoulder formation weeks ago, months ago, and I talked about the failure in the MACD indicator, the failure to cross. That was an ominous signal right there and then. I wouldn't be comfortable to buy the stock even though it is the most undervalued stock on the planet right now. I agree, but I wouldn't touch it until it gets to 129, 130, and that would be a trade, by the way. It wouldn't be buying the stock until and unless we get more assurances from the CCP that they will not harass Alibaba and other Chinese companies listed in the US market. Now, you have to think about it via the psychology along with the technicals. We have multiple players here. Number one, the CCP, they can do whatever they want overnight, anytime they please. Then we have retail investors along with institutional investors, and we have shorts. The moment the CCP started to crack down against Alibaba, it went out of favor. It took a little bit of time, but it went out of favor from institutional investors. And they started to dump the stock aggressively. We're talking about hundreds of billions of dollars wiped off from Alibaba's market value. At some point, the dumping will dry. Institutional investors are done selling. Now, the shorts understood the deal right away. They started shorting Alibaba. And as institutional investors exited the stock, shorts reaped a lot of profits. At some point, shorts will have to cover, initiating a surge, a massive bounce in the stock. And therefore, we have retail investors. This is the other player in this dynamic. They're buying the dip over and over and over and over again. Some of them are assuming that the institutional selling is over and the shorts will have to cover. This is 100% rational. And therefore, you buy call options once in a while, very limited risk. You're not going to buy the stock. You're not going to spend a lot of money here. You're betting on a rebound that will happen out of the blue. The problem with the retail side is, specifically the SPAC generation of investors that invaded the market last year, they have become accustomed that every dip is worthy of buying. And every stock that goes down big, it will rebound big. They're learning the hard way in Alibaba and other Chinese stocks that there is a concept called catching a falling knife. And when stocks go down, they don't have to rebound necessarily. Not every dip is worthy of buying, specifically when the institutionals are exiting. Soon enough, the same lesson will be replicated in the broader stock market. For now, we are conditioned to buy every dip, and the reason is the institutionals are behind us, they're not selling, and they're not selling because the Fed is behind us. The sugar daddy is behind us with the so-called accommodative policy. When the so-called accommodative policy is gone and the Fed has to tighten due to inflation, we will see a dip that will not be bought back. And this will be the ultimate falling knife, and a lot of retail traders and investors, specifically the SPAC generation, will catch that massive falling knife. We have more problems here with Alibaba. They're now firing those employees who leaked the sexual harassment allegations. You think this will fly with US and European institutional investors? Are they going to invest money in a company that punishes whistleblowers who unveiled the sexual harassment allegations? And how far will the long knives of the CCP reach? We're hearing today that the CCP is pretty much banning video games for minors in China. They're regulating how much and how long you can play video games in China. My message is, be careful here. Understand that if you're going to buy Alibaba or any of these Chinese stocks, you're buying it for a trade, not for an investment. At least not for now. And if you have that kind of mindset, you'll do just fine. You'll buy the dips via call options when you should. You'll make a quick profit and you'll move on. But those who are going to buy these stocks on the dips as an investment, there are no guarantees here that the CCP will stop here. Next, let's talk about stagflation, because you might have watched the interview with David Rosenberg on CNBC today. Rosenberg happens to be from the school of thought that we are heading into deflation and perhaps a recession. Now, I have respect for Rosenberg, but you know who I have more respect for? Dr. Doom and Gloom, Professor Rubini. Yes, he has an Epstein side, but who cares? You know you have that too. Shall we talk about it? Or shall we just move on? Anyhow, let's talk about this article from Dr. Rubini explaining why the stagflationary forces will become dominant in the global economy, not just right now, but in the years to come. And this is a long read, by the way. If you don't want to hear it, that's okay, skip. I got the tickers for you in the options market coverage. I know your little brain cannot handle so much information. That's okay. But if you want to stick with me in the doom and gloom party, here we are. The stagflation threat is real, says Dr. Rubini. There is a growing consensus that the U.S. economy's inflationary pressures and growth challenges are attributable largely to temporary supply bottlenecks that will be alleviated in due course. But there are plenty of reasons to think the optimism will be disappointed. And these are snippets, by the way, not the entire article. Until recently, I focused more on medium-term risks. But now, one can make a case that quote-unquote mild stagflation is already underway. Inflation is rising in the United States and many advanced economies, and growth is slowing sharply despite massive monetary, credit, and fiscal stimulus. There is now a consensus that the growth slowdown in the US, China, Europe, and other major economies is the result of supply bottlenecks in labor and goods markets. The optimistic spin from Wall Street analysts and policymakers is that this mild stagflation will be temporary, lasting only as long as the supply bottlenecks do. On the production side, Delta is disrupting the reopening of many services sectors and throwing a monkey wrench into global supply chains, ports, and logistics systems. Shortages of key inputs, such as semiconductors, are further hampering production of cars, electronic goods, and other consumer durables, thus boosting inflation. Still, the optimists insist that this is all temporary. You hear that, pal? Once Delta fades and benefits expire, workers will return to the labor market, production bottlenecks will be resolved, output growth will accelerate, and core inflation, now running close to 4% in the U.S., will fall back toward the U.S. Federal Reserve's 2% target by next year. On the demand side, meanwhile, it is assumed that the U.S. Federal Reserve and other central banks will start to unwind their unconventional monetary policies. Combined with some fiscal drag next year, when deficits may be lower, this supposedly will reduce the risks of overheating and keep inflation at bay. Today's mild stagflation will then give way to a happy Goldilocks outcome, stronger growth and lower inflation by next year. This is the fantasy, by the way. Here is a reality. But what if this optimistic view is incorrect and the stagflationary pressure persists beyond this year? Question mark. Is this worth noting that various measures on inflation are not just well above target, but also increasingly persistent? For example, in the US, core inflation, which strips out volatile food and energy prices, is likely still to be near 4% by year's end. Macro policies, too, are likely to remain loose, judging by the Biden administration's stimulus plans and the likelihood that weak Eurozone economies will run large fiscal deficits even in 2022. And the European Central Bank and many other advanced economy central banks remain fully committed to continuing unconventional policies for much longer. Although the Fed is considering tapering its quantitative easing, it will likely remain dovish and behind the curve overall. Like most central banks, it has been lured into a quote-unquote debt trap by the surge in private and public liabilities as a share of GDP in recent years. Even if inflation stays higher than targeted, exiting QE soon, or too soon, rather, could cause bond, credit, and stock markets to crash. Ta-da! That would subject the economy to a hard landing, potentially forcing the Fed to reverse itself and resume QE. After all, that is what happened between the fourth quarter in 2018 and the first quarter of 2019, following the Fed's previous attempt to raise rates and roll back QE. Credit and stock markets plummeted, and the Fed duly halted its policy tightening. Then, when the U.S. economy suffered a trade war-driven slowdown and a mild repo market seizure a few months later, the Fed returned fully to cutting rates and pursuing QE through the back door. And here is Rubini explaining the stagflationary forces. For starters, there is the trend toward deglobalization and rising protectionism, the balkanization and reshoring of far-flung supply chains, and the demographic aging of advanced economies and key emerging markets. Tighter immigration restrictions are hampering migration from the poorer global south to the richer north. The Sino-American Cold War is just beginning, threatening to fragment the global economy, and climate change is already disrupting agriculture and causing spikes in food prices. Moreover, persistent global pandemics will inevitably lead to more national self-reliance and export controls for key goods and materials. Cyber warfare is increasingly disrupting production, yet remains costly to control, and the political backlash against income and wealth inequality is driving fiscal and regulatory authorities to implement policies strengthening the power of workers and labor unions, setting the stage for accelerated wage growth. While these persistent negative supply shocks threaten to reduce potential growth, the continuation of loose monetary and fiscal policies could trigger a de-anchoring of inflation expectations. The resulting wage price spiral would then usher in a medium-term stagflationary environment, worse than the 1970s, when the debt to GDP ratios were lower than they are right now. That is why the risk of stagflationary debt crisis will continue to loom over the medium term. And this has been your daily dose of doom and gloom. And with that, how about we move on to the market's performance today? And here we go. The Dow Industrial Average closing in the red, down 55.96 points, or a decline of 0.16%. The Qs closing in the green by 136.39 points, or a gain of 0.90%. The S&P 500 closing in the green by 19.42 points, or a gain of 0.43%. Again, the dollar was trading slightly higher, yields were trading down, and therefore the Qs outperformed the general market. But wait till we see the internals in a minute. Before we do that, here is the sector's performance today. Leading the pack at number 1 and capturing the gold medal, technology; at number 2 for the silver, REITs; the number 3 for the bronze, communication services. Meanwhile, the laggards of the day led by financials, energy, and industrials. So the inflationary trade is out of favor today. What about the market's internals? The advance to decline ratio for the NYSE, 38% advancing versus 59% declining. The Nasdaq, 44% advancing versus 53% declining. So the Nasdaq almost up 1% for the day, but only 44% of the components of the Nasdaq were advancing. Meanwhile, 53% were declining. So how the hell did the Nasdaq close in the green decisively? The answer is it was led by a handful of stocks, specifically the big cap technology stocks. Therefore, there was buying of the ETFs and market manipulation via buying call options on Apple. We'll get to that in a second, but first, what happened in the futures market? Here it is. The WTI closing in the green by a little over half a percentage point. Of course, there were bets that we would have seen a higher surge in crude oil prices, and the reason is we have the hurricane over Louisiana. It was an intense storm, but it looks like the damage for oil facilities is minimal, at least for now. On the other hand, gasoline prices are spiking higher here by a little over 1.5%. Grains down across the board, led by soybean down big. We have meats muted, the flat line, slightly to the downside. Meanwhile, metals, we have an outperformance from palladium and copper. Pay attention now, why the hell is copper closing in the green when the inflationary trade is out of favor? Is copper predicting that the dollar will go down? We'll see. But we're seeing underperformance here from platinum, silver, and gold, all closing to the downside. What about softs? Massive gains for coffee and sugar futures. Coffee up about 4% today. Sugar acting sweet with about 1% gains. You can't have coffee without sugar. Meanwhile, OJ futures leading the declines in softs, down by over 5% today. Perhaps we're seeing some profit taking. OJ futures have been the outperformer in softs, and now there is talk about switching from OJ to cocoa futures. We'll see how cocoa performs in the next few days. Moving on to the big casino, the options market. Let's see how the tables did today. The hottest one by far, Apple. And notice the spike in volume here. Almost 1.7 million contracts traded hands today. About 77.5% of those were calls. Tesla, the souffle at number 2. With about 800,000 contracts, about 69% of those were calls. What about the ticker BBIG? Whatever the hell that is. But it's been a meme stock, a massive pop on the Wall Street bets and the likes. And the company's name is Vinco Ventures. Do you even care what the company does? Of course not. You care about the ticker. Somebody spits the ticker on TikTok, Reddit, you get the ticker, you put your blindfold on, and you buy call options randomly. But anyhow, BBIG closed with over 550,000 contracts traded for the name today. About 85% of those were calls. And here are the unusual activities that took place in the options market today, the tickers festival. Let's start with the ticker GSAT. This is the satellite company. And there was a rumor in the morning by quote-unquote analyst, and the analyst said that the iPhone 13 will use the satellite technology from this company. Who cares? Because most likely, this is a pump and dump. Apple will come out later and say, you know what? We have no clue what this person is talking about. In the meantime, we have a squeeze in this stock, surging higher, and they're betting for more gains to come. They bought the 2.5 calls, $2.5 calls with the expiration date of September 17th, with expectations that the stock will rally higher by over 6% by then. They paid about 45 cents a piece to enter this trade. All in all, spending about $2 million. What about the trade for the ticker LUV Southwest? They're making a bullish bet here by buying the 55 calls, buying the dip in airlines with the expiration date of October 15th. They are expecting the name to rise higher by over 12% by then. So is this a call about Delta fading away? We'll see. But they were willing to pay about 50 cents a piece to enter this trade. All in all, spending about $1 million. Here it is. What about the ticker BBIG Vinco Ventures? Somebody's calling a top here by buying the 550 puts with the expiration date of September 17th. I don't believe we have weekly expiration for this name and many other meme stocks, which makes it a little questionable, by the way. Are retail really behind this, or are the hedgies and the likes the ones behind this? Because retail looks for weekly expiration. This is monthly. Anyhow, they're expecting the name to drop by over 22% by then, a crash. They paid about $1 a piece to enter this trade. All in all, bringing the total to about $1.2 million. What about the ticker ANYNE? And this is for a company called Sphere 3D, another meme stock surging higher today. Do you even care what the company does? Of course not. This is an intelligent one, by the way, because there is an element of de-risking. It's a spread, 2 trades, one buying the $7 calls, the other selling the $8 calls, same expiration date, September 17th. They paid $1.40 a piece for the long leg, the $7 calls, and they received in credit $1.20 a piece for the short leg, the $8 calls that they sold. All in all, the entry cost for this trade is about 20 cents a piece. That leaves the profit range to about $1 a piece, which means that the maximum profit for this trade is about 500%. Intelligent, they know the risk, they're not looking for the moon. The goal and the risk are defined in this trade. All in all, they spent about $150,000 for this trade. Here's another one. What about the ticker SPRT for support.com? This stock has been surging, impulsively so, and now the options premiums are out of whack, which is probably paving the way for this stock to crash. Because why would you pay an extremely high premium buying call options on support.com when you have GSAT, BBIG, ANYE, FUSK? It doesn't matter. You have a lot of tickers, all moving higher. This one, the premiums went way out of whack, too expensive, and therefore you will see migration from SPRT to other meme stocks. Anyhow, somebody's betting for more gains to come before that happens. They bought the 39 calls, expiration date 9/17th, September 17th, with expectations that the stock will rise higher by over 7% by then. They paid $10 a piece. This is a lot. It means $1,000 per contract for a stock trading at around $40. This is complete insanity. All in all, they spent about $7.5 million for this trade. It better works out. What about the ticker WKEY? This is for Whiskey International, whatever. Another meme stock surging higher today. They're betting for more gains to come in this name by buying the $10 calls, expiration date September 17th, with expectations that the name will rise higher by over 24% by then. They paid about 70 cents a piece to enter this trade. All in all, spending about $500,000. Continuing with interesting trades. What about the ticker TSLA for Tesla? They're buying the 620 puts. This is a big one, by the way. Perhaps we have some breaking news about to hit the souffle. We'll see. But somebody's buying the 620 puts, with the expiration date of November 19th. They're betting that Tesla will drop down by more than 15% by then. And they paid $22 a piece to enter this trade. That's a massive number, even bigger than the support.com trade, because we're talking about $2,200 per contract. All in all, spending about $15 million. Is this Michael Burry over here? Anyhow, what about the ticker AFRM for Affirm? You heard the news. Amazon is allowing Affirm or collaborating with Affirm for their buy now, pay later program. More debt. What could go wrong? Right? You buy things you cannot afford. You buy them now, you pay later, or you don't pay at all. You say, get lost. What are you going to do to me? Right? You did not even run a credit check before you allowed me to buy. What do I owe you? Get lost. Buy now, pay never. Anyhow, the stock is surging higher, and we're seeing a short squeeze in this name. Therefore, they're betting on more gains to come by buying the 110 calls, expiration date September 17th, with expectations that the name will rise higher by over 11% by then, and they paid about $5.50 a piece to enter this trade. All in all, spending about $3.8 million. Lastly, what about the trade for the ticker QQQ, the Nasdaq? We're in the last hurrah rally to the moon, bro. But somebody is buying protection here, perhaps betting against the Nasdaq by buying the 352 puts, expiration date October 15th, with expectations that the Nasdaq will drop by over 8% by then. Perhaps the seasonality in September will take over. They paid about $2.70 a piece to enter this trade. All in all, spending about $1 million. Moving on to the heat map analysis. What's going on here? No theme at all. If you follow the guideline that I gave you a couple of weeks ago, you'll be fine. The inflation trade is not performing. What's performing is big cap technology stocks, meaning that somebody bought the ETFs today. And therefore, you're seeing mega cap stocks outperforming today. Whether we're talking about Apple, Amazon, Microsoft, Google, Facebook, Tesla, all performing. And the reason is the algos decided to buy the ETF, the NASDAQ, the SPY today. Now, combine that with the market manipulation via buying call options on Apple. And I know a lot of you would say, bro, what's with the conspiracy theories? You don't need that. Yada, yada, yada. I'm letting you in a secret. I might be working for a boutique firm right now, but I used to work with the big ones. And we used to manipulate the market every single morning. What do you think the repo facility is for? And by the way, the easiest way to manipulate the market higher is via buying an enormous amount of call options on Apple. This is how the game is played. Welcome to the jungle. Moving on to the charts analysis, starting with the SPY 30 minutes chart. I want to grab your attention to the RSI indicator here. This is a 30 minutes chart, by the way. We have sell and buy zones in the RSI indicator. Extremes in either way will trigger a sell or buy zone signal. Every time the RSI trades above the normal range, this is a sell zone. And every single time, going back for about a month, every single time the RSI traded at these levels, we saw a pullback. Likewise, when the RSI becomes quote-unquote oversold, aka entering the buy zone, the dips were bought aggressively. So what are the expectations here now that the RSI is trading at the sell zone? The likelihood is we will see a pullback, and this pullback could happen fast during the overnight session. And then the market opens up higher in the morning. So watch the futures chart. How far could the pullback go? We have yet another gap that was open today at around 450. And we have a new support level that I am identifying for you. It is 447. So you have to look out for that. I doubt that the SPY will go down all the way to 447, but 450 is more likely. Continue to watch the RSI indicator from a 30 minutes perspective. But this is the chart of the continuous contract for the SPY, the daily chart, and we are tracking whether this divergence from the trend line will be a last hurrah rally, meaning that the SPY will diverge by about 5% or more, meaning we still have about 1.5% or more gains before topping, or will this be a normal divergence of around 3 to 4%, and we are already at around 3.5% divergence. Are we going to pull back now and revisit the trend line, which happens to coincide with the support level of 4,384.5, or will this be the last hurrah rally? We see the SPY rallying an additional 1.5 to 2% higher. We'll see. For now, the momentum indicators are all pointing for the last hurrah rally. We have the last trading day of August tomorrow. Their intentions could be pumping the market all the way till the end of the month and then let the seasonality of September take over and we see a correction in the market. We'll see. What about the Qs? 30 minutes chart. And here we go again. Every time on the RSI, when we get to the sell zone, we see a pullback in the Qs. Likewise, every time the RSI dips down to the buy zone, we see dip buying, aggressively so, and massive rallies higher in the Qs. Where are we now? From an RSI perspective, we are in the sell zone, meaning the likelihood is for a small pullback to come. Let's zoom in for a little while here. What is the target for the pullback? Well, we have a gap at around 377. Yet we have to identify new support lines because the last support that I have at 365.5, this is way below where the chart is trading right now. So here it is. We have 372 and then we have 369. The expectations for now that the Qs will pull back to close the gap. I doubt that the Qs will go down to 372, but you have to keep these numbers in mind. What do we see here in the continuous contracts chart, a daily chart? Both the MACD and the RSI indicators are now trading positive, indicating a strengthening in the momentum. The chart's trading far above 15,000 and the sky is the limit for now until and unless we get a reversal signal. For now, we don't have any reversal whatsoever. Yet we continue to talk about the possibility of a last hurrah rally. Here is the trend line on the triple Qs, the daily chart, and as you can see, the trend is still intact. And we have divergences here. The typical ones go from 10% all the way to about 19 to 20%. The current divergence that we have is around 12%, which is slightly below average, but we're getting there. A last hurrah rally will mean that we have an additional 4 to 5% gains on the Qs to come. This will be massive. Which sector of the Qs will lead the rally higher? Is it going to be big cap technology stocks? How about software? All I know that the appetite of buying is drying out. Institutionals are buying via algos or call options from time to time. Retail is busy with meme stocks. So who's going to buy the Qs here beside the robots? Again, this is what I'm watching for before we get to September. My crystal ball says the rally could continue for a little while, but we will see a pullback to the trend line mid-September. So this rally could go on for 12-13% divergence from the trend line. But if it gets there, that will be a strong short/sell signal. What about the IWM, the Russell 2000? 30 minutes chart. Nothing to see here. Slight weakness as yields trade down. The reopening trade underperforms and therefore the IWM is just trading flat here. The support remains 223, the resistance at 229. What about the Dixie? The support of 93 was broken. The expectations are we will see a pullback to 92. But remember, this is a fluid situation. Re-tapering expectations. We know that Powell was bluffing. He said he's not going to taper right now. He did not announce any tapering. He went against his own members of the Fed, the governors, the presidents, and decided not to announce a tapering plan. But reading through the lines, we know that he will be forced to taper. The question is when? Will it be in September, October, December, next year? This is what will move the US dollar for now. Here's the thing, folks. My expectations, the next jobs report and the next CPI report for that matter, will come out soft. And the reason is Delta. When that happens, the market will read it as Powell is vindicated. His transitory theory is correct, and therefore the dollar will flush down in that scenario because tapering expectations will go out of the window. Flushing down the Dixie will be good for commodities and good for the inflationary trade of industrials, energy, materials, and financials. But for now, we're going to zigzag between 92 and 93 as the market processes the tapering expectations. The final answer will come this Friday as we get the non-farm payroll report. Gold, what's going on here? Trading slightly down. The dollar was trading a little higher in the morning, and that added pressure on gold. Do we see any reversal signal here? Of course not. This was not a reversal candle. It was a pullback, a slight one. The reversal, if it happens, is expected at around 1,830. And remember, gold has three enemies, two main ones, the dollar and yields. If these two trade higher, then gold trades down. So as a gold trader, you have to watch out the Dixie and yields. Speaking of, here it is. We talked about the retest of 1.28%. It is ongoing right now. We will see if the test fails or not. The definitive answer will come on Friday after we get the non-farm payroll report. In the meantime, my expectations are we're not going to see a definitive move one way or the other until Friday. So the real test is closing the week above or below 1.28%. But understand that the algos will trade accordingly day by day. If we wake up in the morning and yields are trading at 1.27%, 1.26%, or even above 1.3%, the algos will move accordingly. And now you have the guideline to know what to do with the moves by algos. TLT weekly chart, no definitive move whatsoever here, consolidating around 149, waiting and waiting and waiting for more clarity. Again, Friday will be a big day for the bond market. What about the VIX? What's going on here? 4 hours chart. The MACD indicator is still reading negative, meaning we don't have a pop right now. And if this continues, my target is filling the gap at around 15. And this will allow the SPY to rally another 0.5% to 1%. And this will be the last hurrah rally in the SPY. The normal divergence is around 3 to 4% from the trend line. If the SPY continues to rally higher, I will be eyeing anything above 5% as the target to start the pullback. And at that point, perhaps the VIX will close the gap and rebound higher. We'll see. This is a chart for Apple, my leading indicator, and we have a breakout here above the resistance of 150. What does that mean? It means that perhaps we are indeed in the last hurrah rally, and we have a confirmation from Apple that the Qs will rally impulsively higher. Now, bear in mind that the move in Apple happened due to call options buying, so the sustainability of the pop remains under question. Furthermore, we have the RSI and MACD indicators highly extended from a 30 minutes perspective, perhaps an indicator that we will see a pullback in Apple before any resumption of the pop higher. A pullback will not mean going back all the way to 150. It could mean going back to 152, 151.5, and then rebounding higher. I would be concerned if Apple goes down all the way to 150 and breaks that support. And that would be an ominous signal. But for now, we have a confirmation from Apple that the last hurrah rally is ongoing. Here is Tesla, the souffle 30 minutes chart. We had a series of higher highs and higher lows. And finally, the chart broke above 720. Now, this happened before, but it was followed right away with Tesla being rejected once again from 720, breaking that support and trading below. And the reason is, every Monday, we see a pop higher in Tesla via call options. They pump on Mondays and they dump by the end of the week. This has been a consistent pattern in Tesla. Therefore, I'm waiting for the higher low. Will the higher low be above 720? This will be my confirmation that Tesla will indeed trade above 720 once and for all. But if the lower low comes below 720, then I'll be a little concerned here about the sustainability of this pop that we saw today. Tulips, BTC, what's going on here? Nothing, still grinding and consolidating in a bullish formation. I explained the psychology yesterday. I'm not going to go over it right now, but you can watch yesterday's video and I talk in details about the psychology between the whales and the retail crowd. Of course, the retail are busy right now with meme stocks that could translate in pain for cryptos as we see profit taking to chase meme stocks. And lastly, here it is, a meme stock, AMC. And this time around, we're using a 30 minutes chart. We know that 32 is the number to watch. And we had a double bottom rebound before from 32, and that resulted in a massive pop higher. We had another one last week, a double bottom reaction at 32, and the stock surged higher. What that tells me is the participants in AMC realize and they're well aware that 32 is a must-keep level. Breaking and closing below 32 will open the floodgates at a massive flush down. We're now seeing a series of higher highs and higher lows. But was the series of higher highs violated today? This is the question that I have, because if we indeed formed a lower high, then the next step will be a lower low. And then here we go back again at 32. Will it hold this time around? Who knows? So I am watching how AMC will trade tomorrow. Perhaps this is not the high we're looking for. Perhaps there is another higher high. We will see what happens tomorrow. Moving on to the conclusion of this video. What do we have on the economic calendar tomorrow? We have the Case-Shiller Index. This is an important one because there is a lot of talk that perhaps the housing mania and the housing bubble have peaked. The Case-Shiller Index is not only important to confirm or negate that theory, but it is also important and informative when it comes to the inflation discussion. Yes, our expectations for the next CPI to come out soft. And the reason is we have Delta. So the expectations are airfare prices, hotel prices, the spending on leisure and hospitality will go down. Rental car prices will go down. But will that be compensated by the rise in shelter prices? Furthermore, we have the Chicago PMI. This will be important regarding inflation, specifically stagflation. If the headline number comes out down, meanwhile, prices paid and prices received continue to linger higher, if not grow, then we already have a confirmation of the so-called soft stagflation phenomena that Rubini talked about. It's already here. Lastly, we have consumer confidence. This will be yet another important one to watch regarding the expectations for inflation and the pace of recovery. All of these numbers, when they come out, they will impact the US dollar and yields accordingly. You have the guideline to know exactly how the algos will react according to the moves of the US dollar and yields. And with that, ladies and gentlemen, I'm done here. This is all I got for you for now, but I will talk to you again tomorrow. If you found the information presented in this video helpful, please subscribe, press the like button, the notification button, and follow me on social media.